The title of my speech this year is Our DFI Role in a Changing World. What I would like to do is to take you through the changing landscape that we operate in and explain how that impact on the role of DFIs in general, and in particular, Norfund's role as an active strategic minority investor. The world is changing, so are we. Some of the changes are a bit surprising and paradoxically. I'll start by some of the macroeconomic environment that is changing, then moving on to address the role of private sector or private capital flowing into developing and emerging markets. Then say a bit about what Norfund has been doing over the last year, and end up with a theme of the day, how to promote, how we believe that we contribute to promote financial inclusion. We still believe that Africa is rising. That's been sort of the theme for quite some time, though what we see, it certainly is a bumpy road. And it's much more bumpy today than only a few years back. We started with this Economist front page, the last one a couple of weeks back, Africa's fragile democracy, which is the case. We see it in some of our countries too. Democracy and human rights is pressured more than a few years back. Economy is growing less. That creates tension in Africa as in Europe. But let's address some of the macroeconomic environment that we see. We've seen in general commodity prices collapses. We're probably now at the end of a super cycle. We've seen over the last few months that some of these indices is starting slightly to climb again. A lot of our countries depend on commodity. But probably even more important, the fact that El Nino has caused drought in large part of Africa, from South Africa to Ethiopia. Some of these countries with 60 to 70% of people living from agriculture, more or less subsistence agriculture, well, that hurts. Security, of course, we have the Horn of Africa, which is still a problem, also for the neighboring countries, or the issues they have in north of Nigeria in terms of terrorism. The more difficult economic environment also spell over into political stability or instability. One example, last week, the president in Kenya decided to put a cap on interest rates, which will hurt the bank sector. It may help him be re-elected next year, but it definitely will hurt the economy of that country. Currency turmoils, we've seen a lot of our countries, currencies being devaluated by 30, 40, and up to 50% over the last 10 to 12 months. Of course, that creates a lot of problems. Again, yesterday, the new president of the African Development Bank strongly recommended African countries not to take on board more euro bonds. A lot of countries in Southern and Eastern Africa have, over the last few years, been able to raise significant bond in the euro market. Their currency depreciate by 30, 45%. Well, that creates a lot of problem again for the government. Why does this happen? Well, partly because they have deficits in balance of payment and government deficit, but largely this is a byproduct of quantitative easing. All of this short cash floating around in the world, in and out. South Africa particularly being hurt from that. But we also see economic mismanagement and what I referred to in Kenya, I would basically say is part of that. But then, as always, Africa is not Africa. And it's quite a different story in different parts of it. Here, basically, the countries where we are heavily invested, Started with a star performer, East Africa, still maintaining fairly significant growth, including the economic powerhouse, Kenya, expected to grow by 6% this year. Why is this? Well, fairly sensible economic policy. The East African community succeeding more than any of the other parts of Africa in regional integration. And this is also where we see that the new middle class plays an important role on the demand side. And probably also in terms of political stability, despite what I said about Kenya, it's perhaps better than other parts, even though Ethiopia is struggling these days. Southern Africa, much bleaker picture, 1.1% expected this year. In South Africa, the big powerhouse, less than 0.5%. They're shedding huge number of people in mining sector and other parts of the economy. Unemployment is growing. Zambia, and we will hear from the governor of the central bank of Zambia later, Denny Kalialia, more about that country, but of course it's dramatically hit by the copper prices. And El Nino important because in several of these countries because agriculture is so important. West Africa, we're moving slowly into West Africa. Much more about oil prices, particularly Nigeria. Nigeria is in recession for the first time, I think, in close to 20 years. The economy is shrinking. Ghana a bit, perhaps more at the end of a downturn and coming back up. But a very bleak picture in terms of economic growth. Nigeria, who rose to being the #1 economy in Africa last year, now is back #2. Partly because of currency, partly because of recession. Again, South Africa is #1, not that South Africa is a big success story. The broader picture comparing sub-Saharan Africa to other parts of the world, well, they're growing less, but it's not like a disaster zone. There are other places that are doing less good, though what they need is South Asian growth. What we have to hope for the future is the 6 to 8% growth for a couple of decades. That would change the continent. That would offer employment. Then a bit about sort of what's the role of Western capital flowing into these markets. What's important for development? And I'd like to speak to 5 issues. The role of Western banks, portfolio flows, I mean pension funds like the big Norwegian government pension fund, and foreign direct investment. And as part of that, partly private equity funds, partly what we, the DFIs, well, I probably didn't explain again the DFIs when I started. Development Finance Institution. I mean, we are 15 more or less similar institutions in Western Europe investing in developing countries with a mandate to eradicate poverty. Some of the paradoxes. What we see is basically that Western banks are moving out. They're lending less and they are exiting on the equity side. Or some months back, Barclays Bank, after a century operating profitably in Africa, declared that they would leave, they would exit. That sent shockwaves through financial sector in Africa, particularly central banks. Are we untouchable? What's wrong with Africa? The point is, there's nothing wrong with Africa. This is political and regulatory risk in the US that spill over into Africa. It's so risky to be responsible for banks in Africa. Anything goes wrong, you maybe find billions of dollars far beyond the position, the exposure you have in Africa. But also Western banks are lending less. We'll come back to the role of Western Bank also at the end and later today when we explain why a rise is happening. Portfolio plays, sort of what the pension funds are doing, the short-term capital in and out, buying and selling at the stock exchange. Well, these numbers to the left are for emerging markets in general. And most of all, it's extremely volatile. And to the right, it's not so much about poor parts of the world. Perhaps only to the better for them. Because these flows, they're also a part of the currency instability, and it doesn't provide capital for long-term growth. It's in and out, and I think also the Norwegian debate over the Norwegian pension fund, I'm not sure it would be a good thing for Africa to have a lot of these investments coming in to small and very sensitive stock exchanges around the continent. But the important thing, it's not important for development. What is important is foreign direct investment. Again, these are the numbers for FDI to developing and emerging markets compared to official development aid. And as you can see, the scale is entirely different. And from mid-90s, investment started to flow back. People willing to dig in, to own and build companies. Of course, again, it is about the BRICS, and it's about middle-income countries, and not about the poorest part of the world. The lower part, FDI for sub-Saharan Africa, it's a low number by international standard, but it's a big number in Africa. It's a very significant number in Africa. And the overall message is this one. Look at the numbers of poor people in the world, and how it's been declining, the right-hand scale over the last 20 years. And it's much about FDI. Even China is about FDI, not because they don't have the savings and the capital, but they didn't have the technology and the skills. So for that reason, to me, FDI is really the crux of the matter. And that's the first sort of lesson again in terms of the role of Norfunds and DFIs. This is FDI to country group depending on the level of development or income for FDI in general and for Norfund. And we're doing largely what we're asked to do and what we should do. We deploy our capital in the poorest part of the world because that's where it's needed, and that's where it's difficult for private sector to move, but that's also a private investor. But that's also where, when we can be catalytic and help private capital coming along, we're doing our job. Then let's speak a little bit to the issue of private equity. And I have my good friend here, Sev, who's been working with Norfund since 2002. Hear more about that later in private equity. Private equity, again, in terms of capital flows from the West is probably something of the most important, because they invest in companies, they own them and develop them. And it's been a growing story for Africa, sub-Saharan Africa. And if you look at the numbers, it's also profitable. I mean, compared to the broader MSCI Emerging Market Index, the return to capital in Africa is twice what you see in the broader emerging market space. So it's a profitable undertaking, and it's been growing. And people like Sev has been important in making that happen. Implications for Norfund in this space, probably two. What we do in the fund space is what we call filling the gaps. We're trying to invest in funds where private capital is not available. That's much about SMEs in the poorer countries, and it's about early stage or venture funds. So that's the one story. The other one is beyond funds. PE funds typically have a holding period of 3 to 5 years. Useful, but it's not for the long term. What we're doing and what we will end up with in my speech is explaining why we have been so concerned with setting up what we call platform companies with an industrial or skill base to build, operate a portfolio of companies on the ground. Because they're having a longer time horizon and with a more industrial skill base that goes beyond what the funds can do. Bit about the numbers again and the paradoxes. Well, let's start with the banks. This is largely the role of Western banks in emerging markets. They're going home. They were more useful during the colonial period. It's really strange. The portfolio plays, I mean, the norske oljefond kind of people, well, I mean, they come and go. No significant trends. They come and go. And you don't rely on them. The big story again, the important thing is FDI. It's been growing since the mid-90s, but keep going. It doesn't seem to be all that cyclical, though you see it different in different geographies, but in the overall emerging market, it's growing. And then the DFIs, the Norfunds. We are also growing. We're growing even more rapidly. It's important that this is indexed to 95. So it's not a level. Of course, FDI is extremely much bigger compared to the DFIs. But the DFIs are growing and taking a more prominent role than we did. But I'll come back to that in a minute. Before that, I'd like to, if I'm able to get my tongue around the word, I'd like to introduce John Kay, who in his last book, Other People's Money, explaining how Western financial markets actually work. John Kay is professor at London School of Economics and a journalist in Financial Times, and he, in his last book, introduced this word, financialization. It doesn't exist in any word book, but it's actually a very important word because it characterizes the modern financial system in the West. What is financialization about? Liquidity is king. Buy and sell by the hour or by the day, and profit for the short term. Don't dig in. Don't put yourself in a position where you're responsible for a company for growing it. Just buying and selling. A lot of it you can do by computers. And this in a Western market where you have huge excess capacity, excess liquidity, largely because of quantitative easing. Central banks in Europe and US have been printing money like crazy since 2009-10. So there's plenty of money, and for that reason, interest rates are close to zero. So that's the Western financial market. That's what John Kay is calling financialization. Moving to the developing world, well, that's where this capital could be put in good use. That's where capital is needed to build a real economy, not to buy and sell, but to build. And what we see, well, we see Western banks are leaving and hardly and less willing to lend for development. Pension funds and portfolio investors, well, they're volatile and short-sighted and really about financialization. They drive financialization in many ways. PE funds, which is my star sort of performer today, even though here the message is, well, where there is plenty of private capital, is PE fund investing for the midterm in terms of holding period in mid-cap and in middle-income countries. Moving to poorer countries and smaller deals, well, that's where there's still a need for Norfunds. So implication again for us, we see that what is needed for development is equity investor with a longer term and with an industrial skill, understanding what we're doing, holding on, building and building companies. And in the financial sector, and that the rest of the day is much about the financial sector, helping innovative, high-quality banks able to scale and to take down cost to grow. One of the reasons that the president in Kenya imposed this, to me, quite stupid and harmful regulation of interest rates was that interest rates was 25%. And gross margin is like 15%. In Norway, it's 1.6%. Banks, financial sector, microfinance, and banks, far too expensive. We need to scale, we need to use new technology, we need to be innovative. We need to find those banks and help them grow. a bit of a digression. You will hear later from the new General Secretary in Søren Andreasen in EDFI about what EDFIs are doing. So this is just a sort of teaser. The new kid on the block after the Addis meeting last year in terms of future, the finance of development for the future, is the DFIs, is the Norfunds. And we are seen in the broader policy debate as being more and more important. The EU is all about private sector and how to foster more support DFIs. We have agreed with them on a European level in EDFI to set up management companies managing their money. So, and you will see more and more of it. And why is that? Well, the European EDFIs last year had 36 billion euro invested. They invested 6 billion only last year. They have 800 people staff spread out across developing and emerging markets. And they're growing. From 2005 to 15, from 11 to 36 billion US. And then back to the policy part of this. If you look at the growth over this, they're tripling the portfolio. Only a very tiny part of that was due to capital injections from the owner, from the ODA budget. So by 0.7% of ODA injected in new capital in the DFIs, they were able to triple. Able to scale by increasing debt finance, and because they're profitable and are able to retain the profit. So the DFI story is going to be a much more important one, and you will hear more about it later today. Back to Norfund. So the buzzword that we're sort of trying to get across to you today is an active strategic minority investor. What does that mean? Well, let's start very briefly describing what we're doing. We have committed 15.5 billion. We have invested in directly and indirectly in close to 700 companies. We have depending on how you measure the return to investment, we basically traditionally say that our success story is investment return in investment company. We don't invest to take the money back and spend it in Norway. Due to the currency fluctuation, I mean, we delivered only 3.5% in investment currency, but 18.7% in NOX, and we have since inception delivered 10.5%, 11% in NOX, and 6% in investment currency. It's a viable operation. That's the point, and that's why. If you look at the capital base, the value adjusted capital 19.3 billion, 3.8 billion retained profit, and we believe that when we exit there will be 4.4 billion extra in values. So we can grow, we grow by ourselves, and we grow because our owner believe in what we're doing, and we just heard from Børge Brende. We have had a capital injection every year since inception. Last year we committed 2.4 billion. We basically, at the present sort of financial setup, we can commit between 2.5 and 3 billion. This year we estimate it to be 2.7. This is a list of the investments we did over the last 12 months. Let me only draw your attention to a couple of them. Africa Essential Food, which is fish farming, largely in Lake Kariba. Two things. On one hand, fish farming is something this country knows a lot about. So we have been able to convince some of the best people in the Norwegian industry to serve on a board and help this company grow. What's the challenge for this company? Well, just mention one. A lot of what they do is producing in Lake Kariba in a dollarized Zimbabwe economy. And then they take a part of it to Zambia and sell it for kwacha. Kwacha down, I think, roughly close to 50% over the last year. Well, That's a difficult proposition, I can tell you. So the currency fluctuation and instability in the financial system creates a lot of problem also on a individual company level. Freight in time in Kenya, a lot of what we do now is what we do in agri and food value chain. So trying to understand the whole value chain. Then, of course, logistic is important. That's why we did freight in time. You need also to be able to move the goods to the market. The bigger development agenda, I think, again, today not controversial at all. It is about jobs. Jobs is what we're doing. 382,000 employed directly in our investees. They again purchase local services for 22 billion NOK, creating jobs. We provide electricity, 18.5 terawatt hour, I think similar to comparable to consumption of 25 million. I mean, this is sort of how we create and going through the thing. We provide loans for 37 million people and businesses, and our businesses pay taxes, buying down aid dependency in poor parts of Africa. To me, this is development. I'll show at the end, and probably outside, there is copies of a report we just published on how we create development. Take it, bring it, read it, but this is basically the story. As I said before, sort of the buzzword we have is that we are an active strategic minority investor. Active in the sense that we serve on board. We have had all our board members, non-Norfund and Norfund board members, for a seminar this morning and a dinner last night. So we serve on board, we engage with management, we provide strategic guidance in terms of where these companies should go. Strategic by selecting poor countries and limited number of countries, selecting sectors that we know and where we can provide competence and skills and guidance. By doing so, maximizing a development impact. Minority, we're never a majority, usually up to 35%. Sometimes we also do joint venture. So we spent some time trying to understand who are we and who do we compare to, who is our peers, and we will come back later this year. But it's much about understanding how some of these evergreen investment companies, some of these good private, we'll hear later from Ferd. Ferd is probably one of the sort of model things that we would like to look into. How do Ferd invest? What's their internal procedures? We'll come back to that. I said because of sort of going beyond PE fund sort of logic, it's much about what we call platform companies, setting up industrial companies, being able to themselves develop and operate a portfolio of companies. Usually they will take a controlling stake, but not always. But they have capabilities to operate on the ground, not we. So they sometimes operate in geographies where we're not very familiar. Our role is to serve on a board, to give guidance in terms of strategic direction, but basically influence through board and through partners. And then when they're successful and when we like what they're doing, fund growth. As long as they're growing, and that's the RISE story again at the end of the day. Come back to that. In financial institution, to the left, we have the new platform Arise. Fantastic story, if you ask me. The Nordic used to be Norwegian, the Nordic Microfinance Initiative. You'll hear more about that. Norfund with KLP and other private partners is a co-investment vehicle, so it's not really what we call a platform company, but it's very important as a vehicle to mobilize private capital for development. In clean energy, it's much about SM Power and Globelec, and then a strategic partnership with Scatec. But that's, again, it's not a truly platform, as we call a platform, but we work closely with them, and we have a string of investment, and more will come. The theme of today is about financial inclusion and what we do in microfinance and what we do in banks, particularly in Africa. So I'll finish by sort of explaining sort of the overall rationale. And in terms of financial inclusion, I think that there's at least two dimensions. On one hand, sort of the true developmental, creating jobs, economic growth. What is needed for long-term poverty alleviation. At the other end, social impact, improving lives at the bottom of the pyramid for the poorest people in the world. And they doesn't always come together. That's why if you see, and when you think about what you will hear later today about the RISE, doing banks in Africa, NMI, the Nordic scaling up the Nordic microfinance initiative, well, they have the strength in each end of this spectrum. They both, it's not that they're in one or the other end, but to us, they complement what they're doing. So to us, we're really addressing the broad agenda of financial inclusion. Speaking very briefly to RISE, it's a partnership between Rabobank from the Netherlands, biggest agricultural bank in the world, FMO, our Dutch counterpart to Norfund, and Norfund together with Norfinance. So Norfinance and Norfund will take up 48% of the share. We're merging all the assets that we have at the present into one company, and promise to fund that to grow it to 1 billion company on investment in financial institutions in Africa. And we believe that we are so spot on. There's nothing that is more needed to help the banking sector in Africa grow. Create innovative banks able to take down cost and scale. But that's more for the latter part of the conference. As part of the RISE, in the last part of July, I traveled, started in Tanzania, traveled to Kenya, Uganda, and then ended up in Zambia, because these are big institutions. We need regulatory consent to do what we're doing, so we need to talk to the governors or to the central banks and capital market authorities and so on. We started out in Tanzania, and that's why I'd like to explain very briefly the response from Benno Ndulu, the governor of the central bank. You will hear more from Zambia, my last country, later, the governor in Zambia. We were sitting there, and I was traveling with Barry Martin, the CEO of Rabobank International, and Nano Treiklepp, CEO of FMO, and we started to explain what we're up to. And then he just stopped it halfway through. For the first time, somebody's coming here and helping solving our problems, not creating new problems in terms of the financial sector. What we need is exactly what you offer. We need investors able to manage risk, not avoid risk, just sell out and go back, to provide banking skills and technology and governance, help us grow better banks for the long term. But this is just, again, to introduce do you hear me? Do without this. The team and the importance of central banks. But the message was the same across these countries. We came into the central bank, we had a meeting with the governors, it's exactly the same message. This is what we need. And this is exactly opposite of what Barclays Bank is offering. We came there, we said, we believe in Africa. It's a bumpy road at present, but we believe in Africa rising for the long term. We would like to be there, we like to invest in your financial sector. Earlier this year, we were able to take the Norwegian microfinance to a Nordic level, primarily by introducing our Danish partner, DFI partner, IFU, as an investor, raising Fund 3, $87 million. This was Johan Andresen's initiative initially, 2006-07, which sort of ended up in Johan and Norfund and others setting up the NMI in 2008, first $100 million US. Now we took it to the next level, and we hope to be able to take it to a Nordic, I mean, beyond Norway and Denmark, perhaps a broader, one of the big institutions investing in microfinance. Microfinance is not sort of hype anymore, but it's still useful if it's done the right way. Don't believe in all the hypes. They're never true. This is the report I recommend you to read. It probably is available outside here. It's explained why and how we create development, why private sector, why profitable businesses is so important. And I may even dare say why there is no other way to fight sustainably poverty for the long term. Thank you.